Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing we want to do is open up our brokerage platform. The one I use is Tasty Trade, but you can use whatever you like. And of course we're going to be selling or writing options contracts, so we need to know where we are in the option cycle. So if we just pull up any underlying, let's just say Apple, we're now presented with a list of expirations. Ideally, 30 to 60 days out in time is perfect. 45 days would be ideal. However, anything between 30 and 60 days is okay. We want to stay away from the weeklies and we want to stick to the monthlies. The next monthly available is October 18th, 11 days out in time. That is a little bit too close. So we're going to go to the next monthly, November 15th. That is 39 days away. And now that we know our contract is going to be 39 days out in time, we can use that information, come over to our watch list, and filter out any underlying that has earnings over the next 39 days. The reason for this is we do not want earnings to disturb our trade. It will increase volatility, it will mess up your deltas, and all of these things are going to have a negative effect on your P&L. As well as filtering out anything that has earnings, we also want to filter out anything that has a low liquidity level. The reason for this is we want tight spreads, and we want to be able to get in and out of positions easily, so we need a good liquidity level. Now all that's left to do is sort everything from a high IV rank to a low IV rank. We want to be trading, we want to be selling contracts in a high IV environment. So anything above 50 is considered high, anything below 50 is considered low. However, there can be situations where anything above 30 is deemed acceptable, but generally speaking, above 50 and below 50. So before we actually look at some positions, we want to keep in mind what's already in our portfolio. If we're already too heavy in any one sector, we want to stay away from that sector, and we don't want to be too heavy in any one area. You want to stay nice and diverse, and that will also help your P&L over time. So now we just go through the list. Obviously, we've got some Chinese stocks at the top. IV rank on these have been very, very high recently. XLE has had a very high IV rank for a little while. EWZ is the Brazil ETF. It's got an IV rank of 57.5 for an ETF. Anytime you can trade an ETF, I would always go with an ETF over a company. As long as you can still get paid a decent amount for it, because when you trade an ETF, you eliminate company risk. So it's just one less thing to worry about. EWZ, very nice IV rank. So let's take a look at EWZ. We go over to the trade tab, and we know, of course, we're going to be 39 days out in time, November 15th. And this is now the options chain. And this orange horizontal bar shows you where the price of EWZ currently is with respect to the remaining strikes. And this vertical orange bar shows you the expected move of EWZ over the next 39 days. So what are we going to do? How do we make money out of this situation? So we want to be selling contracts or writing contracts. What are we going to write and where are we going to write it? So there's two types of contracts, calls and puts. We want to sell one call, one put. You can say whether you're selling, you can say whether writing or selling, it's the same thing. Writing and selling contracts is the same thing. So we want to sell one call and one put, and we want to sell it outside of the expected move to give us a high probability of success. I like to go anywhere between 15 and 20 delta. So on the call side, we've got an 18 delta here, which is perfect. And then on the put side, we've got a 19 delta here, which is perfect. So as you can see, our strikes, our contracts are outside of the expected move, and this is going to give us a very high probability of success. And if we look at the probability of profit here, we've got a 66% chance of making money on this position. And if we wanted to get out at 50% of max profit, we've got an 84% chance of hitting that target. So a very, very high probability trade here. And if we were to plot this on the chart and see what that looks like, we'd be plotting price levels at 27 and 32, because that's what our strikes are. So 27 and 32, which is here. So this is the range that we've essentially created for ourselves, and we want price to stay within this range. And if price stays within this range at expiration, which is 39 days out in time, then it means that we collect 100% of the premium that we collect. So what is the premium that we collect? It's this number here, 53 cents times 100 shares, because there's 100 shares per contract. That's a $53 premium here. And our broker is going to require $364 in buying power to open this position. So we're going to use $364 and we're going to collect 53 up front. This is a very nice return on capital trade, especially for a naked position. This would be suitable for almost any size account. It only requires $360 odd. Even an account as small as $5,000, this would be suitable. So with that being said, there is one other thing that you need to keep in mind, and that is the size of your positions. So we have a position sizing template here that's free for everyone to use and get a copy of. The way it works is you enter in the size of your portfolio. Let's say if it's $42,358. Below that, you will then enter in what the current VIX level is. Let's just say if it's 31.9. Below, everything will be automatically calculated for you. All you need to do is just use the information to form the backbone of your portfolio. If you don't keep your position sizing in check, eventually when something does go wrong, it will wipe you out. So this is very important. It's free for everyone to use. It will tell you how much buying power to allocate to a single undefined risk position, a defined risk position, how much buying power to allocate to short premium strategies in general, how much of your portfolio you should allocate to that. And for anyone that wants to get a copy of this, click the link in the description, head over to free position sizing template, and it will take you to where you need to go. For anyone that does want to copy our trades and see what positions we're placing and essentially just make money with us, again, click the link in the description, head over to EDS Premium, get yourself signed up. Inside, you'll have access to all of our portfolios, so there'll always be positions for you to copy. There's a full course, so no prior knowledge is required. We will teach you everything you need to know. It's a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money-back guarantee. So once you've studied our full course and followed our trades for 6 months and haven't seen results, then we will work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part. Right now, the price is £1 a month. It will be increasing. However, once you're in, you don't need to worry about any price increases. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.